Okay, let's dive right into this explainer because we are tracking a massive macro setup unfolding in the markets literally as we speak. Now, get this. The last time we saw this exact scenario play out, over $1 billion in leveraged positions were completely wiped off the map in under an hour. $1 billion. And today, we're staring down the barrel of another impending liquidation event. The crazy part is, the whole thing is about to be triggered by something as entirely mundane as a single PDF document being released in Washington, D.C. Wall Street isn't guessing about what comes next either. They are actively positioning their portfolios for impact. So over the next few minutes, we're going to break down the exact macro playbook that decides where the entire global market moves next. Right now, a specific Bureau of Labor Statistics data release is acting as a massive trap, and Wall Street is bracing for the shockwave. We aren't just talking about a few nervous traders shouting on the floor anymore. We're talking about algorithmic trading bots programmed to parse this specific PDF in absolute milliseconds. When we see a liquidation alert of this magnitude, it means that immense amounts of over-leveraged capital are just sitting on a knife's edge. It's basically a high-stakes waiting game where billions of dollars hang in the balance, entirely dependent on one highly anticipated piece of economic data triggering those algos. And to show you just how on edge the market really is, Bitcoin is already bleeding below the critical $64,000 mark. The reason the margin for error is razor thin right now is because there are billions of dollars in open interest sitting just below current price levels. And all that leverage, it acts like a giant magnet for liquidities. If this one economic number comes in wrong, your portfolio isn't just going to see a minor dip. The entire market is at severe risk of a cascading wipeout as those leverage positions get forcibly closed out. The volatility we're about to see requires some serious preparation. Which brings us to Section 1, the trap, and what the US CPI actually measures. So to truly understand the threat facing your portfolio right now, we have to look closely at the Consumer Price Index, or CPI. But hey, we aren't just talking about the basic cost of groceries or energy here. You already know all about that. What makes this specific CPI print so dangerous is the stickiness of services inflation. This is often called supercore inflation. The Federal Reserve is currently hyperfixated on this core CPI metric. Frankly, they are terrified that underlying inflation is becoming deeply entrenched in the service sector. They're basing their shifting dot plots and monumental financial decisions directly on whether this specific, sticky inflation is actually cooling down or not. Actually, getting inflation down from that wild 9% spike back in 2022 to the roughly 3% range we see today, that was actually the easy part. What we're looking at right now is the whole concept of the last mile of inflation, grinding from 3% down to the Federal Reserve's restrictive 2% target. Well, historically, that's exactly where central banks make massive policy errors. They over-tighten, they break something in the economy, or they panic, pivot too early, and inflation rebounds. We are currently sitting right smack in the middle of that dangerous last mile, and the Fed is absolutely terrified of letting that inflation number spike back up. So, the absolutely crucial point for any global trader is this mechanical relationship. If inflation stays hot, the Fed is forced to keep interest rates high, literally sucking liquidity straight out of global markets. But if inflation cools down, they finally get to hit that rate cut switch. And let's be honest, modern financial markets treat the prospect of a rate cut like an absolute dopamine hit. When that switch flips, it releases a tidal wave of fresh capital directly into risk assets like stocks and crypto. It's a completely binary outcome, dictated entirely by the data. All right, let's move into Section 2, the Bitcoin target and risk on liquidation. Look, before we go any further, we need to bust a major myth right here, right now. You've got to forget the fairy tale that Bitcoin behaves like digital gold during an inflation crisis. Sure, retail investors might still buy into that digital gold narrative, hoping it acts as a safe haven when inflation runs hot. But algorithmic trading desks and institutional money, they certainly do not trade it that way. If you're sitting around waiting for Bitcoin to protect your portfolio during a CPI spike, you're playing by an outdated set of rules that Wall Street abandoned a long, long time ago. So, instead of acting like digital gold, Wall Street views and trades crypto strictly as a highly speculative, high-beta, risk-on asset. Think of it as a massive high-beta liquidity sponge. In traditional finance portfolios, hedge funds use Bitcoin as the absolute tip of the spear when it comes to risk. When global liquidity is abundant and money is cheap, they buy it aggressively to juice up their returns. But the second liquidity tightens, they dump it faster than almost anything else in their portfolios just to protect their capital. Meaning, we're facing two violently diverging paths today based on this impending data. On one hand, if the CPI number comes in hotter than expected, the Fed pauses any planned rate cuts, the US dollar index spikes, and we see a cascading leverage wipeout dragging Bitcoin straight down to the $60,000 zone. Yikes, right? But conversely, if we get a cold CPI print, the market assumes the inflation beast is finally dead. Rate cuts are confirmed, the dollar drops, and that provides the exact macro fuel needed for a massive rocket rally towards $68,000 and beyond. And the primary reason behind that massive sell-off during a hot CPI print basically comes down to this single number, 5%. Right now, there are roughly $6 trillion parked away safely in money market funds. $6 trillion. If inflation remains stubborn and the Fed freezes their rate cuts, yields on U.S. Treasuries stay elevated. Institutions instantly pull their capital out of highly speculative assets like Bitcoin simply because they can lock in a perfectly safe, risk-free 5% return. I mean, why risk the massive roller coaster volatility of crypto when you are guaranteed a 5% yield by the United States government? That $6 trillion is just waiting for a reason to either deploy or stay exactly where it is. Now for Section 3, the global domino effect. Now, this entire dynamic isn't just isolated to Bitcoin. Not at all. Institutional giants like JP Morgan are targeting a massive 8,000 level for the S&P 500. But make absolutely no mistake, that entire bullish thesis relies completely on the assumption that the Fed will continue easing monetary policy. You see, an 8,000 target on the S&P implies a massive multiple expansion. That basically means investors are willing to pay much, much more for every single dollar of earnings. Mathematically, that level of multiple expansion is practically impossible without a massive flood of cheap money. If the CPI data ruins the rate cut narrative, those lofty stock market targets, yeah, they are going to be radically revised downward. And this brings us to the capital flight mechanism. In macro circles, this is often conceptualized as the dollar milkshake theory. When U.S. inflation spikes and the U.S. dollar strengthens against other major global currencies, it creates a massive vacuum. Historically, we've seen this exact setup absolutely devastate emerging market currencies, kind of like what happened during the Asian financial crisis in the late 90s. A strong dollar forces international investors to yank their capital straight out of global emerging markets, draining liquidity from stock exchanges in places like London, Tokyo, and India. All of those billions are instantly redirected straight back into U.S. cash reserves. A single percentage point deviation in US CPI can literally shift billions across global exchanges in milliseconds. Okay, final section, number 4, your 3-step survival playbook. With all of these billions shifting across global exchanges so rapidly, you absolutely need a concrete 3-step survival playbook to protect your portfolio over the next 24 to 48 hours. Please do not try to play hero here. Step 1, drop your high leverage positions entirely or just move to cash. The first 15 minutes after CPI release are pure chaotic algorithmic noise. You will see violent whipsaw price action specifically designed by trading bots to hunt stop losses on both sides of the market. Just let the dust settle. Step 2, watch the US dollar index, the DXY. If the DXY dumps, risk assets will rally. That is your very first reliable directional signal. And step 3, keep your eyes absolutely glued to that $64,000 Bitcoin support zone. A clean daily candle close above or below the specific line will ultimately give you your true macro direction for the weeks ahead. So, as we wrap up this explainer, I want to leave you with this final thought. Based on the exact macro playbook we just broke down together, how are you reading the data? Are you positioning your portfolio for a triumphant Fed rate cut party? Or are you bracing yourself for a much deeper market correction? The trap is set, the numbers are about to drop, and the next move is yours.